So if you think that you're going to sell your company, you should think of that 2 years ahead of when you want to sell. So don't wait until you're completely burned out. Keep in mind that you will have to make a profit at some point in time. And so ideally 1 or 2 years ahead of selling. And also keep in mind that when your company is growing at decent 20, 30, 40% year-over-year rates, that's probably the sweet spot for selling. It is pretty much as in North America. There's significant liquidity, there's dry powder, significant funds have been raised in the past 24 months, and that has to be deployed. And one interesting development is that traditional private equity firms are more and more interested in tech, which used to be a very specialized field that no one really understood about because of the higher multiples, because of the lack of assets, for example, or real tangible assets. And these days, you're seeing more and more of these traditional private equity firms going into tech. And that's increasing competition and also driving multiples up.
Hey, everybody. Welcome to the Practical Founders Podcast, where every week we hear an amazing story from a serious founder who built a valuable software company and did it without big funding. I'm your host, Greg Head, and this week my guest is Juan Ignacio García Braschi, the CEO and managing partner of L40. They're an M&A advisory firm for practical SaaS founders, primarily in Europe, but they also work with companies in North America, Latin America. So today we're talking about what's going on in growing practical SaaS companies and eventually selling them to financial buyers, strategic buyers in Europe. We talked about the factors that affect valuation or the red flags or challenges that come through a deal, how founders should be thinking about it, what's going on in the money markets that fuel all this acquisition, and how founders can make the most of their valuable asset, their software companies. Welcome to the Practical Founders Podcast, Juan Ignacio. Good to see you.
Thank you. Thanks for hosting me.
Yes. You look like you're at a top floor office somewhere in Europe. Where exactly are you today?
I'm in Madrid, Spain at the moment. Yeah.
And
It's rainy, wintry. But
it's
keeping
not
myself
always
busy.
beautiful in Madrid. Maybe it's not the high tourist season right now in Madrid.
It's work season.
Yes,
Yeah.
excellent. There's seasons for that. Well, I'm excited to have you on. You're talking to founders and buyers and helping them transact acquisitions and deals, partial, full acquisitions, financial buyers, strategic buyers, all of that, all over Europe and also North America and Latin America as well. So you're the cross-border sell-side M&A advisors for SaaS founders over there. So we have lots to talk about today. There's a lot of activity there. Juan Ignacio, why don't you start with what is your firm, L40, and who do you focus on helping?
Sure. We're a small M&A boutique. We're 3 partners, offices in Madrid, Miami, and Lisbon. 10 people in the firm, so overall a very small group, but really hands-on. We close 5 to 6 deals per year. We work mostly with B2B SaaS company. I would say that we are not your typical investment bankers in the sense that we have also been founders. I myself was a co-founder of the company called Cabify, which was like Uber for Spain and Latin America.
Yeah.
Then I founded a lending platform in the US. So yeah, I've seen deals from many different angles, not only as banker, but also as a seller, as a buyer, as a lender even. And that type of angle is generally very helpful when we're looking to help a founder exit their business. We're active in both the Americas and Europe. Deal size typically between 20 and 200 million. That would be the lower mid market. And that would generally equate to ARR being 5 million to 50 million broadly.
Okay.
We work with
And what
B2B
is the
SaaS
sweet spot
companies.
that's most typical within that range? That's a pretty big range, of course.
It's a pretty big range, and it's purposefully big because we like to help companies at different stages. And sometimes we help companies that are thinking of selling in a couple of years. They become quite big, and we still can help them exit and figure out the right buyers. Typically, I would say 50 to 100 is the narrower range in which we generally work.
For the exit value, I would say.
Correct. Yes.
And is that 100 million euros or dollars? There's the difference these days, right? Yeah.
Yeah, I would say dollars. Yeah.
Oh, okay, great. Yeah, that's right in the practical founder zone. We can see that 90 to 95% of software acquisitions, VC funded or bootstrapped or somewhere in between, practical, are for under $100 million value when they sell. So that's most of the market that's right there. How long have you and your team been helping SaaS founders sell their companies and represent them?
So our firm is relatively new. We've been around a couple of years,
Yeah,
but we as a team had worked together in our previous company as lenders in the B2B SaaS space.
right.
So we're a very close group since probably 6 years ago now.
Hmm.
And yeah, our individual careers in the finance world span. Like mine personally is 20 years and my partner's pretty much the same. So yeah, been doing deals, I would say, for all my life.
And what's the background there? Did you work for the big investment banks or something like that in Europe or?
I did. I started my career as a banker at Merrill Lynch. I was working with tech companies as well as infrastructure and construction. So those were the two verticals that I worked on. Then I went on to a private equity firm, becoming an investor, a buyer.
Hmm.
Closed probably a dozen transactions in those days
Yeah. Hmm.
as an acquirer. And then I went on to be the CFO of Cabify, which was also about fundraising. Sometimes even we acquired a competitor, we sold, we spun off one of our divisions. So yeah, really exciting days. And again,
Right.
always been doing deals and closing deals.
And what happened to Cabify? Did that sell and move on? And you guys said we like the sell side part of it. We like doing these deals.
Oh, it didn't. It's
Yeah.
still running.
Okay.
I would say as a bootstrap company now.
Oh, fun. Yeah.
Yeah, we raised 500 million, so I wouldn't say qualifies as bootstrap, but right now it's profitable
Okay.
and no need to go to the market anymore. I was a board member there up until July 2025, so
Uh huh.
really close to the company. And I finally left when I got fully involved at L40. And but yeah, I'm still very close to the team, and I can tell you that they're very happy with how the business is going now.
Yeah. Happy to be alive despite the funding, right? And sustainable. I would say, right? Does that make sense?
Exactly. Yeah,
Even
that's
though maybe
that's
they're
not as easy as it
underwater,
seems,
yeah, with the funding, but yeah.
especially in the ride-hailing industry, which is very demanding in terms of capital.
Okay. Well, excellent. And you also help tech founders with debt with Bupos. How much debt did you deploy as part of that company?
So we worked with smaller companies, B2B SaaS as well, but
Okay.
generally sub
Uh-huh.
5 million USD in ARR. And we deployed close to 100 million USD, mostly in North American companies,
Yeah.
working very closely with founders that had significant experience in building SaaS companies, generally bootstrap businesses.
Yes. Uh-huh.
Our lending product, didn't that make that much sense with VCs, and yeah, we exited that one year ago.
Okay, great. So you work mostly with bootstrap founders with your debt financing, which is very practical, makes perfect sense for those that want to grow efficiently and have a predictable model. Do you work with both venture funded and bootstrapped or lightly funded practical SaaS founders these days, or is it more on the bootstrapped practical side at
We
L40?
work with both, I would say. In the end, what happens these days is that if you want to sell your company, you have to be Rule of 40 compliant. So that means revenue growth plus EBITDA margin being 40 or higher. And that generally means that VC-backed companies are eligible, but maybe eligible for the wrong reasons, because in the end, a buyer will want to see some degree of profitability.
Yeah.
So we work with some VC-backed companies, but these are companies that have matured already and that they're making a profit and are ready for an exit and are at a much more stable type of situation. I would say probably 70 to 80% of the companies we work with are fully bootstrapped or
Right.
close to that. Maybe they raised some money in the beginning. This new trend called seed strapping. So
Yeah.
that's definitely a thing. People that raise a couple of million
Yeah.
and then they bootstrap thereafter.
So that practical funding, it doesn't weigh you down too much and doesn't take control of the company and can help you get started and stay practical, right? So practical founders includes bootstrapped and lightly funded companies. Sometimes it's angel funding or something like that. So we see that. And we'll talk all about that. I mean, used to be you needed more VC funded to get going, and there's still some markets where that's required. But most don't in B2B SaaS, and especially with AI coming in, right? Even less so required. Let's talk about regions here, and we'll talk about the general M&A game for SaaS founders in the practical zone that you talked about. What regions of do you work with founders, and where are the buyers? Is it totally global, or is it pan-European, or Spain and UK, or what regions are you active in?
The good thing about being active in the tech space is that generally most of the buyers are pretty much geography agnostic and they will buy businesses globally. I would say our core focus is European founders. We also work with North American founders and in some cases even Latin American founders, which come from my closer network. Given
Yes.
I was involved in LATAM for
Yeah.
a long time, as well as my
Yes.
partner who lived in Colombia for a long time. But yeah, I mean, buyers come from pretty much anywhere, and they don't care so much about geography, but mostly about products that can solve a global pain.
That's a little different than I'm hearing from investors, growth equity investors, and some private equity investors that are acquiring. They kind of the ones I'm talking to lean towards North America. They're familiar with the legal system and the financial accounting, and they play less in Europe and other parts of the world, India and the rest. But you're saying buyers are pretty agnostic. They're looking for valuable companies, and it almost doesn't matter where they are.
I guess it depends on the type of buyer. But yeah, if you work with people like, I don't know, to name a few, Alpine Investors, TA Associates, all these guys
Yeah,
have platforms that have a global type of footprint.
right.
Obviously, they tend to acquire mostly in North America because they're more familiar with the legal system, as you mentioned, but
Mhm.
also the market is bigger. You have a bigger number of companies, but they won't say no to a successful company that is based out of a credible jurisdiction in Europe or
Okay.
in Latin America.
Okay.
We've
And you have
seen many success
partners in
stories.
L40 that are in Lisbon, Portugal, and Miami as well, and you have built a network of potential buyers, right, that expands every time you represent a company, as a sell side advisor. So you're working for the founders to represent them to find buyers when they start a process. Is that right? That's
That's
the typical scenario these days?
That's correct. We like to side with founders to remove any type of conflict of interest.
Yes.
So we're working for them all the time. It's obviously that we need to have a very good relationship with buyers, but
Mhm.
they're not our clients. And we will always make sure that we are unbiased and providing unconflicted advice to the sellers.
Yeah. Okay, so now we got a lot of questions. I have a lot of European founders. They want to know what's happening this year with buyers. What kind of buyers are out there? What kind of valuations? What kind of expectations are happening? What kind of deal structures? What's going on in Europe? What can you say generally about the regions in Europe? And are buyers different? Are founders different? For instance, in Spain versus France or the Netherlands or Germany versus the UK, right? Or Brazil versus Colombia in Latin America. Can you say there are some general differences in expectation and, you know,
I would
culture and
say,
valuations, or I don't know,
yeah,
something? Yeah.
if you rewind back like 15, 20 years,
Yes.
that used to be the case because those were the B2C days in which everybody
Ah,
was building to kind of obtain or acquire the local market. And
Yeah.
those were very local markets with a very narrow focus. But these are the B2B SaaS days, and that type of business tends to kind of solve global pains. And
Yeah.
we're seeing more and more that founders have a more like a broader scope when they're launching their businesses, and they want to go either pan-European or try to go to the States. So I think in general, think of European founders from different countries, they tend to have relatively similar mentalities.
Yep.
Sometimes I see them having the same questions and issues, and they think, for example, that they're always wondering whether they should hop on to the US because it's a more
Uh-huh.
competitive market and you need to invest more and so on. That tends to be part of their conversations pretty much every day, but they're less and less scared every time. I think there's a convergence in founder mentality these days.
Yeah. What do you see with heading to North America? We have the opposite here in the US and Canada, North America, that eventually expands to Europe or English speaking UK, Australia, New Zealand, and then Europe, and the well-worn path there. What is typical for the European software companies you're dealing with? Practical founders growing from 5 to 20 million. Are they pan-European and starting in the US, or can you grow a
That's
valuable and
quite
valuable company in just one country? And
Yes, I mean that's where I see them mostly. I mean, if you think of companies that are at 5 million ARR, they will always have some degree of geographic diversification in their revenue streams.
I see.
Sometimes they won't have launched in the US. They are focused on several European markets. Some of them will just go straight to the US. So, for example, we sold a company last year, First Promoter, which was an affiliate marketing management platform.
Yep.
And these guys were based out of Romania. They had a very, very lean team,
Uh-huh.
15 people, and they were selling probably 95% in the US market. They
Yeah.
had a very good solution for this type of referral marketing management. And they acquire companies or customers pretty much virally, like word of mouth. People who use the platform as referrers end up, running a referral program and using the platform and so on. And they had this mindset that they had to go to the US from the very beginning.
Uh-huh.
And that's one of the reasons why they scaled that fast. And we see that type of thinking in many cases. Many companies we work with have that type of mindset, and yeah, that's interesting.
Okay. So we do have more of a convergence these days. Buyers are forcing it, and founders are, getting the knowledge they need and expanding fast for the kinds of founders that you're talking to. You talk to a lot of founders, and I'm sure you give a lot of advice, and we'll make sure people know how to connect with you if they have questions for you. What is your ICP? What makes a type of founder that would make sense to for your firm to represent them versus not?
We like to work with people who are open to listening to advice and getting advice. That's probably the first very important thing. They need to be coachable to some extent, and people that want to learn how the M&A process works so that we
Yeah.
can help them go through all those stages. Ideally, they shouldn't be very anchored in a valuation that is completely off market, obviously, because that process is going nowhere. So
Yeah.
we want to make sure there's a clear intent of selling. And other than that, in terms of companies, I would say bootstrapped, growing 20, 30%, EBITDA profitable, very sticky customer base, strong GDR, NDR,
Yeah.
those types of metrics. That's ideal, but you don't have to check all the boxes in that sense. It's there's a market for pretty much every company. Some companies are just not ready and the timing is not right. But in general, there are ways to sell companies that have scaled to a significant ARR, and you don't have to be so worried about not checking all the metrics boxes. It's more about being understanding of what the valuation range is and what the types of structures that buyers will propose and that type of thing. So people that we like to work with and people that like to work with us. There has to be some sort of click in the connection because we're going to be working together for like 6 months. So that has to work out.
Is that a typical time frame these days? Maybe it's a little faster, sometimes a little bit longer, depending. But it generally takes about 6 months to start and kick off and go through and transact the process.
We sold the company last year. It took us 4 months, and that's a complete outlier. I mean, that's way fast. So you should expect this to take 6 to 9 months. That's a realistic time frame. Because you have to get ready for going to the market, because you want to make sure that you negotiate the best deal and you want to take time to discuss offers, put them side by side and so on, because there will be a due diligence, legal contracts, and you want to make sure that those legal agreements protect you as a seller. So if you want to get everything right, you shouldn't rush that much. That's my advice.
This podcast is sponsored by my friends at Lighter Capital. In the last 15 years, Lighter Capital has helped over 600 software and SaaS founders secure simple, non-dilutive financing to grow a little faster without giving up any precious equity to investors. I know the Lighter team well, and several bootstrap founders they have helped have already shared their success stories on this podcast. Simple debt funding from Lighter Capital can range from $50,000 up to $10 million with straightforward terms, no personal guarantees, board seats, or covenants, and up to a 4-year payback period. Go to lightercapital.com, that's Lighther capital.com, to apply and get a quick pre-qualification. Then talk with their experienced team to create a practical funding plan to achieve your goals. Now back to our podcast. Is it speeding up or slowing down these days? There's plenty of money out there to acquire valuable software companies that has to be put to use, but there's a higher standard, I'm hearing, out there.
There's a higher standard. There's a process involved. I remember back in my Merrill Lynch years, we were able to sell companies in like 3 months. But that's not the case anymore. I think this has been going longer and longer over time. And unfortunately, you can't compress that these days.
So you actually need to be able to grow, like you said, you'd grow and maintain momentum through, let's say, up to a year-long process, right? You can't, because it's very distracting. It's one of the reasons folks hire M&A advisors is for the help and the therapy, so they can run their business and keep the numbers up, that kind of thing.
Exactly. So one of the first things that we do with founders is review their budget and work on a projection that we can share with buyers, and making sure that the projection is not especially aggressive. We want to make sure that there's a plan that can be fulfilled so that you deliver consistently through the months that the process lasts.
Right. Yeah, don't drop the ball as you get into the process there. So you can help with the process. You find potential buyers. You have a lot of relationships for companies that are looking to buy, that you can find more buyers and gain leverage for the founders. You help in the negotiations, so the founder isn't negotiating directly with the buyer. What other benefits are there for founders of working with an M&A advisor like yourself?
I would say the first advantage is that you maximize price, you maximize valuation, you put all the buyers side by side at the same time, you negotiate with them, and you extract the most value by working with someone who's done this thousands of times or hundreds of times.
Your first time, you want to have somebody on your side that has done this thousands of times.
Exactly, because it's a complex process and it has many different stages. You got to negotiate the price, but you also have to make sure that the due diligence works well. You want to make sure that the legal agreements that are in place are strong enough for you as a seller. So you want to make sure that you get all those tiny things right so it doesn't backfire after you sell. You also want to negotiate what's going to happen with the team, and all those things we know about, we've seen it, and we can help with those tiny details and making sure that you get the best valuation and at the same time the best overall or holistic type of deal.
And also probably through the process, manage expectations, because buyers are on one side and founders can have all kinds of expectations about what strategic buyers did in the COVID boom time, right? Versus what a financial buyer is likely to do these days. Can that get out of hand in the process, or you make sure that people have reasonable expectations to start with?
That's very important. We have to make sure that before we kickstart the process, which could be a big time waster for all of us involved if we
Right.
don't close,
Yeah.
we are aligned in what's going to happen, what type of valuation we can get, what type of deal structure we can get, how long it's going to take, the potential ups and downs that we're going to see through the process,
Right.
the types of negotiation stances that we're going to find on the other side. So all those things, we like to be very open and very transparent ahead of starting any process. And
Uh-huh.
we also help navigate these tiny bumps in the road
Yes.
whenever they happen. That's also important. Sometimes I like to say that we are like psychologists for the
Yes.
founders.
Yes.
Yeah,
M&A therapy.
exactly.
Which is quite stressful. Most founders on the podcast have described their transaction process as the most stressful part of all of this, even though it was very hard to build a business. And sometimes it goes smoothly, but it's emotional. It's important. A lot of founders feel out of place, negotiating with 10 lawyers on the other side, and big companies that have done it a lot there. Okay, so for your practical European software companies, let's talk about the types of buyers that are out there. Obviously, financial and private equity buyers of all types, some strategic buyers, and there's some new variations. What are the typical landing places for a growing SaaS company in Europe?
I would say for the smaller ones, there's a new type of buyer out there, which is the permanent capital type of company. This was
Buy and hold. Yeah,
yeah, buy and hold. This was perhaps initiated or started by Constellation, but you have many similar companies these days.
right,
And what they do is they buy software companies and they hold them
right.
permanently.
Yes.
Sometimes they will replace the management, sometimes they will keep it. But I would say that if you want to optimize valuation, that's not the best type of buyer. I
That's
would
a
say
good
an easy
home.
buyer.
Yes, right. Yeah.
Yeah, it's the process is relatively smooth, and if they commit to a deal, they will close it. But valuations tend to be perhaps not that high, and also if your company has scaled to 10 million ARR, that type of size, this might not be the best buyer for you because they will have to stretch their financial resources to acquire you, and they might not offer the best conditions, and you will have different types of acquirers out there. So I would
Okay.
say the second type. And well, before getting to this one, the second type I would say is a traditional strategic buyer, and that could be rather than a competitor, someone from your ecosystem that is running a larger company and that has some capability lacking that you built, and so they want to acquire this capability that you built, and you or your company makes sense within their offering. I would say that the legacy software companies are not that acquisitive these days,
Yes.
and they will be very opportunistic. So sometimes there will be a match, but that's not the type of buyer that's taking pretty much every single deal right now. The third type of buyer that we're seeing right now is the financial sponsor. So that could be a private equity firm that has acquired a company in a specific vertical or a specific niche or product, and they want to roll up several smaller SaaS companies around that one. So they might have built, I don't know, an accounting software for half a billion USD,
Hmm.
and they want to plug in, say, I don't know, invoicing, tax reporting, other CFO tools around that, and they will be aggressively acquiring companies in the 50 to 100 million USD. Those deals should be accretive, but they generally can pay higher multiples compared to the other types of buyers. And they're looking to have an exit in 3-4 years at a much higher valuation, obviously.
And so they have a need to acquire and solve the revenue growth, inorganic growth challenge, right? It's part of their playbook, and they're active out there, as opposed to some strategics, which their valuations are down, they're slowing down in their hiring, and sometimes they're not even overpaying for, strategic acquisitions, right? Which used to be the classic way, to go get the most valuation. Are you still seeing some strategics, with higher
We are seeing
valuations?
some
Yeah,
of
okay.
them. Back in the day, everybody's dream was, let's sell this company to Google or Adobe or whoever,
Uh-huh.
Oracle, whatever. But these companies tend to acquire maybe $1 billion, $2 billion deal every couple of years. And that's because there's some very important strategic need that they
Uh-huh.
need to, or a strategic gap that they need to fill. And so that is not the most likely type of buyer for a 50 to 100 million USD company these days. It might
Okay, so
happen, but
yeah.
it's not the most likely case.
Okay, so it's most likely a financial buyer of some sort. We have the buy and hold, which are very active in Europe right now. And you have Constellation here and others, Banyan Software here in the States that are doing it. But in Europe, we had Luigi Malardo of Wofu in Barcelona. They grew a very practical company and sold it to Visma. And we've had others that sell to Bending Spoons in Italy, right? They're collecting these businesses and growing the profit streams on top of each other, right? And buying companies with cash. SaaS Group is another one that's
Yeah.
active in the buy and hold category. And then you have the strategics backed by private equity. Are private equity buyers, financial buyers, going directly and buying smaller companies, or does it always have to be an add-on to something else if it's not buy and hold?
It depends on they typically tend to acquire directly when it's a 200, 500 million
Uh,
transaction, and that would
yeah.
become their platform. When it's smaller deals, they tend to put it together with a larger platform. That
Okay.
doesn't mean that you have to speak with the company. You tend to speak with the private equity
Ah,
firm, and they are the ones that will connect you to their platform. And they say, well, this makes sense for XYZ company. You should speak with them. Let's work on this together. And so
yeah.
what happens is that you have to, they're valuing both the strategic fit and how the product works and so on, but also the metrics.
Yes.
And you have to kind of check both boxes. If you check both boxes, you're going to get a very good valuation with this type of platform.
So you need to both have a solid Rule of 40 plus business, right? Profitable and growing, and have a good strategic fit in that case
Correct.
to do it. And of course, they're financial buyers that are backing, so they're not going to go crazy with valuations along the way and due diligence there. What can you say to founders generally, European SaaS founders, 5 to 20 million ARR, about valuations? I get questions about this, and I know the factors that affect valuations, but what can you say generally? Maybe we can go through the key factors that affect valuation, growth, profitability, et cetera.
There's like a threshold or a bar at 10 million ARR.
Okay.
And so if you look at businesses in the 5 to 10 million, multiples tend to be 4 to 6, maybe 7 times in some cases, ARR.
Or a Rule of 40 company that has good metrics and momentum, right?
Yes.
Okay.
Yes. And I'll get to what affects that range or where in your
Thank you.
range you could be. But then if you think of 10 to 20 million ARR companies, they tend to command a premium over that. So it will probably be 5 to even up to 8 times ARR, depending
Mhm.
on a few factors. The metric that correlates with valuation the most, or valuation multiple the most, is growth. So if you're growing 50% year over year, you're going to get a significant premium compared to growing 20% year over year. That's the most important one. Other than that, obviously having good retention metrics, having a solid product that won't be disrupted by AI or whatever trends in the market, that's also important. And being able to show significant profitability, not only double-digit type of EBITDA margin, but ideally 20% plus. Those are the things that will get you to the higher end of the range.
Okay. What about some other factors that are coming in here? We're using AI in the business to be more efficient, and we are getting leverage there that we can look at. And we have some AI features in the product or AI products in the pipeline. Is AI, I guess it has to have traction, but like, where is AI in the valuation story?
So AI is more in the realm of fundraising at the moment.
Okay.
Most successful AI companies are scaling fast,
Yeah.
raising money, growing rather than selling at the moment. I
Hmm.
don't think AI is that much of a driver in terms of M&A these days,
Okay.
but it's obviously part of the conversation. And the type of things that buyers will look into is, will AI disrupt this product? Are they using AI to make the product, one, more efficient, and two, more attractive? So that's things that people are looking into,
Hmm.
but not generally a valuation driver. I would say also
So unless it
because
shows up in the financials, it's a nice to have right now.
yes, and also because most of the companies that are selling these days are like 5, 10 years old.
Yeah.
Um, and so AI is still pretty new compared to that, I would say.
Okay. What about so the retention and gross dollar and net dollar retention, which is logo churn and and upselling. But what about contract length or other things that are going on in the business model? Marketplaces, tech-enabled services, are those attractive in any way? Probably marked down.
Markdown, yeah. We're selling a marketplace at the moment,
Yeah.
and it's a B2C marketplace, and it's selling for a decent amount of money. I would say 4 times revenue, net
Yeah.
revenue.
Yeah.
Um, So that's not bad for a marketplace, especially this size. But generally they tend to be, obviously there tends to be a markdown compared to B2B SaaS, in
Hmm.
which retention and recurrence of revenue is very significant, and the revenue stream is very solid, and obviously that tends to be valued in the multiple.
Well, valuation, the multiple of revenues or EBITDA, is what everybody talks about. Maybe it's a starting point, but it's not the only term in a deal. There's deal structures, buyout percentages, what happens to the founder or the company after it's acquired. What other things should founders be thinking about in the whole deal, not just valuation?
Those are very important topics. And then there are a few others that tend to be overlooked. First of all, if you're dealing with a reputable counterpart that has good financing and that won't change their mind through the process, that's a very important one. So you have to make sure that they don't have other priorities, and that at the end of the 6-month period, they will back
Mm,
out. That's,
seen
that's
that.
I would say, one of the most important things. Also, getting the legals right is very important in terms of, and that these are things that lawyers know better than I do, but you would have to look into MAC clauses, material adverse change clauses, a good shareholders agreement if you are going to stay as a shareholder, so that at some point in time you could end up selling your stake,
Hmm.
and you won't be diluted, for example, with capital increases and so on. So that type of thing is very important. Obviously, the most important topics are what you mentioned. What's going to happen with the team? Should I continue running the business? Can they fire me if at some point in time things don't go well? What will happen with my earnouts? Will I get them? Will I not? Will I be able to impact the P&L, or will they be running the company on my behalf? And so I will be in their hands to collect the earnouts. Those are probably the most economically impactful topics that you will need to look into.
What's the difference between an earnout and selling a majority of your company where you still retain and roll your equity? Would you
Well,
consider those to be different? You know?
there's a big difference.
Yeah.
If you still own a stake, you're exposed to all the upside. So if the company is worth 3 times more, then your stake is going to be worth 3 times more. And sometimes that's very attractive to founders. Um, you're also not selling the company, so you're keeping a part of that, and there will be some degree of interaction with the buyers. And in some cases, that's good. In some cases, you don't want that. So it depends on the preferences. But yeah, I would say economically, the most important one is uncapped exposure versus earnouts that are generally contained in the terms of I mean, there's a cap in the amount that you can get. Sometimes they're uncapped, but if you want to collect significant amounts, you will have to scale to probably unrealistic levels.
So
So
be
I don't
careful
know.
what your forecast looks like when you're selling a company because they might hold you to it for your earnout.
Yes, and so I mean, if it was my company that I would be selling, I generally would prefer, especially if I'm happy with the business, to retain some sort of minority stake so that I can continue being involved in the business and exposed to the upside. But that's not always the case for pretty much every founder. Sometimes they will just prefer to get some sort of earnout and kind of move on mentally a little bit more.
Right. What percentage of founders that you work with in these transactions really don't want to stay very long with the acquiring company? It's a different world. They're entrepreneurial. Is that something that you can negotiate upfront?
It's something that you can negotiate. I would say most of them don't want to linger on for a long time
Yes.
because in most cases, they are product people that have scaled to a point in which they have to either appoint a CEO or hire a large sales organization, and they don't like that. So they want to move on to perhaps starting another business or doing something completely different. And so that's one of their key motivations. And you can definitely negotiate that. You won't be able to make it shorter than 1 year. That's, I would say, the minimum, the bare minimum that you should stay in the company. And typically, 2 years is very common.
So people should expect that. Make sure that the business continuity keeps going.
Yeah, and I would say that if you're willing to stay longer, then that's a positive for the deal. It's going to make things much easier.
Okay. Right, because they want to ensure that it's going to continue growing and meet the expectations. If you've done this a long time, you realize that not every acquisition works, right? Founders leave and things fall apart and, you overpaid.
Yeah.
I think that's the history of M&A is most strategics overpay and underdeliver in the long run to shareholder value. What can you say about how founders should be ready to engage in a process working with an M&A advisor like yourself and your team to shop the company and transact, starting with, get your financials in order and, manage the company. And you're talking to a lot of founders a year or 2 or 3 before they transact. But what is your recommendation for transaction readiness?
Yeah, I would say we are comfortable interacting both with founders that are ready to exit and they want to kind of get an immediate exit, as well as founders that are 2-3 years away from that happening and they want help to get ready. I
Yeah.
would say getting your financials in place is very important. So,
Does that require a CFO or an audit
that's
or
not
what
necessarily
level are we talking about?
I mean, you could get your financials right with perhaps a very small finance team, and it could be
Yeah.
internal, it could be fractional, so long as you're getting your accounting right and you're getting your metrics right, and there's traceability for both of those, then that's fine. You don't need a full-fledged CFO that will tell the story, that will build presentations and so on. We are there for that. I mean, we can do
Yeah.
that role, and you don't need that. You don't need to spend that much money in a CFO. I think CFOs are typically for like larger companies that are looking to scale
Okay.
even bigger.
Okay.
But you have to get those rights, and those right. You got to get the financials right. You got to get the metrics right, and that's going to be important.
Okay. What about legal and organizing the team so the founder isn't involved in every process, or I don't know, documenting processes or being
Yeah, there are
compliant?
a few things.
Yeah.
Yeah, there are a few things that need to be taken care of ahead of a sale. Generally, you can work on that a few months ahead of the sale. So things like making sure that everybody has signed an intellectual property assignment to the company, your trademark is registered, your contracts with your key customers are in place, and they're running and they're in good standing. All those things, you have to make sure that you have them ahead of due diligence process. If you don't have them, it's not a deal breaker, but it won't look well. But that's something that you can take care of, like relatively close to
Yeah.
the transaction. Organizationally, if you want to have a quick transition, obviously you have to make sure that the team can scale without you ASAP. Sometimes you can sell and tell the buyer that they will need to hire a CEO, and that will be acceptable. Actually, many buyers are able to bring
Right.
a CEO to the companies that they acquire, but it's
Mhm.
not ideal. That will be, I would say, that will narrow the buyer universe. And so, yeah, also, if you have contractors all over the world, you have to make sure that you're getting the legals right. Sometimes, you will be running a grumpy organization, and you've been hustling, hiring people in Kenya or Bosnia or whatever, and you didn't take care of making sure that they signed everything right, and so on. So
Uh-huh.
those types of things you will have to look into ahead of closing a transaction, definitely.
So the red flags that could be deal killers, I mean, if what you say your financials look like and the metrics aren't actually the case, right? That would be a problem. Are there any other red flags that throw a deal out of the process?
I mean, I would say mostly the founder not having the right attitude towards a deal. And that could mean, for example, not wanting to sign a non-compete agreement. Those types of
Okay,
basics in which
interesting.
there's some degree of mistrust between the parties that will kill a deal. If it's minor things, as in, I don't know, tax were not filed correctly last year or filed correctly last year, or the trademark needs to be registered now, and so on. All those things can be fixed. Maybe they will affect the price or the deal structure or the reps and warranties in the legal agreements and the SPA. Those things can be worked around. But if you have a wrong attitude about the deal, then that will definitely be a deal killer. Sometimes there's a large dependency on customer or a platform. Those will be deal killers, especially if they show up in due diligence and you were not upfront about those. That's also important.
What is the level of major customer, like our revenue dependency on a major customer that is a deal killer? Is it 20% or 30% of revenue comes from one customer or two?
It, I mean, it shouldn't be a deal killer if you're upfront about it and
I see.
people take that into account and consider that as part of the deal structure. So they will perhaps structure an earnout that includes a retention component. So you have to
Ah,
retain this customer for at least a
right.
couple
That
of
makes
years or
sense.
three.
Yeah.
So it shouldn't be a deal killer. What happens is that if you haven't disclosed that ahead of starting the process, and then it pops up in due diligence, that could be a deal killer because that's something that was unexpected, and it breaks the whole kind of trust relationship that we've built among the parties and ourselves as well. So
Right.
if you have these type of things that maybe don't check all the boxes, you should disclose them ahead and you should not be defensive about them. It's just, this is a very good client and we want to continue operating with them because they're very profitable and we like them and we feel there's no risk in them churning. And we also have a very successful product that attracts all these other customers. And if you frame it like that, it will all make sense. Obviously, if there's just one single customer, then that's a risk that in most cases is really hard to kind of reflect on the price, right? It's mostly a deal killer, but 20%, 30%, 50%. It's just a matter of making sure that it's disclosed, and it obviously will affect valuation, but it won't kill the deal.
So you talk about the right founder expectations and disclosure and building trust and having some flexibility through the conversation because it's a relationship, a win-win, right? So there's a lot of give and take that goes through the process. We hear horror stories from founders who get an offer and an LOI and go through a process and they get retraded, renegotiated in a deal. And it's not always quite that simple. It's not every potential buyer has a great reputation through the process. How do you help founders deal with that? Do you build all these relationships with buyers and know who to trust and not to trust and their deal styles?
Yes. Yes, there's a few things that sometimes buyers will go out of their comfort zone in terms of acquiring a company that is not in their geographic scope and they're not
Right.
familiar with the market. That's a risk. You
Okay.
sometimes you want to take it, but generally you will deprioritize that buyer in favor of other ones that are familiar with that particular legal system or geography and so on. Financially, we also make sure that the buyers are sound and have the money, because sometimes people will lock an LOI and they will try to
Oh,
optimize funding in the back, and that you will be surprised that happens even
yes.
with very large companies.
Yes.
You would think this is a behavior for like small hustlers acquiring 5 million deals, but no, it happens with 50 and 100 million deals as well. So you have to make sure
Mm.
that they have the financial capacity
And
and
how do you verify that? Do you literally in the process say, "How are you financed? Can you prove it?"
I mean, we know them. Obviously,
Okay. Okay.
if you have a financial sponsor backing you, then that problem is mostly solved. Unless obviously they're running out of cash in the fund that they invested, but that's generally not the case if they're placing an offer.
Mhm.
So that gives a lot of comfort. I would say, yeah, so long as they're in our network and we ask the right questions, we end up getting a good understanding of whether they're ready for completing the transaction or not.
Okay. What happens when it's a strategic buyer, private equity backed or not, that is a competitor that wants to roll you up? Maybe you've got something unique in your product, or maybe they just want to acquire customers. It's always been very sensitive. How do you treat competitors who are looking at acquiring?
We're generally cautious in those interactions. And I would say one of the reasons is that in most cases, your most likely acquirer won't be a competitor. It will
Ah,
be a similar platform or a platform in a similar space that is looking to acquire your product and increase their scope with their customer base. Competitors, I mean, why would a competitor that's got like 60% market share acquire additional 10%
mhm,
by paying a high M&A type of multiple? So that's unlikely. And I mean, sometimes they will place an offer, but they will be opportunistic. And so you don't want to disclose your full financials and obviously your customer list, those types of things. We keep them hidden from them, or we
okay,
relatively sanitize all the info to make
mhm.
sure that we don't overshare with people we don't want to. Unless they're very serious about it and unless they make a strong indication that they want to buy, we won't go very far in disclosing too much.
A $10 million SaaS company in Spain, B2B SaaS, wants to sell their company, works with you. You go through the prepping process and verifying the pre-due diligence to help them get ready, and you're ready to shop it. How many potential buyers do you reach out to for a company of that size that would be good prospects when you shop the company?
It depends a lot on the type of company.
Okay.
Some of them will be very niche, and there will be a very narrow list of potential acquirers. So that's
Yeah.
a more like smaller process. But I would say, on average, we end up reaching out to probably 100 buyers.
Hmm.
There's quite a lot of interest these days in B2B SaaS, and
Yeah.
there's quite a lot of active buyers. So
Right.
ballpark, yeah, that's what you can expect.
And the bigger the company, 20, 30 million, the more prospective buyers are out there because there's a lot of financial buyers. I'm hearing, at least in North America, there's more financial buyers that with more money, that are buying bigger companies than they are buying $5 million companies, for example. So,
You get better buyers, and by better, I don't mean that the ones that are acquiring smaller targets are bad. They're very good and they're very professional, but the bigger ones tend to be well-funded, and they have a clear mission to deploy, and that means generally higher multiples.
yeah,
So
right.
they're better in that sense, right? From the seller's perspective, that's obviously better.
Can you say generally what's happening in Europe with private equity around SaaS companies? There's plenty of funding. Is it a good deal season in Europe for SaaS companies?
It is. It is pretty much as in North America.
Yeah.
There's significant liquidity. There's dry powder. Significant funds have been raised in the past 24 months, and that has to be deployed. And one interesting development is that traditional private equity firms are more and more interested in tech, which used to be a very specialized field that no one really understood about. Um, because of the higher multiples, because of the lack of assets, for example, or
Yes.
real
Uh-huh.
tangible assets. And these days, you're seeing more and more of these traditional private equity firms going into tech. And that's
Mm,
increasing competition and also driving multiples up.
excellent. Well, thanks for all you do to help these practical founders achieve the next phase of their dream when they've decided that now's the time to start transacting their business, sell a piece of it or most of it, or keep going there. What advice or what perspective do you want to share with practical founders out there, European SaaS founders, that you could say to them if you had a crowd of 1,000 of them, as you do here, and they're listening? What can you say to them about what their expectations? Maybe they're at $1 million ARR right now, and someday they imagine selling their company.
I would say try to not over raising. Over
Yes.
raising is something that will kill your company, even if it's very healthy. So if you want to raise, make sure that you raise the right amount to take your company to the right scale. Plan ahead. So if you think that you're going to sell your company, you should think of that like 2 years ahead of when you want to sell. So don't wait until you're completely burned out. Uh, Keep in mind that you will have to make a profit at some point in time. And so ideally 1 or 2 years ahead of selling. And also keep in mind that when your company is growing at decent 20, 30, 40% year over year rates, that's probably the sweet spot for selling. If you keep on going for too long, then you might kind of be too flat for a sale. So that would be
Mhm.
the sweet spot. Also, just don't go too early. If you're growing 2 or 3x year over year, you qualify for VC funding. You might not want to take it, but you will definitely want to continue owning your asset because
Mhm.
it will be much more valuable in 1 or 2 years from now.
If you're growing fast enough, it's going to be way more valuable in 2 years. So don't sell it now. Keep going. Right.
Exactly.
All right. That's great advice. Thanks for sharing your perspective, Juan Ignacio, and what's going on in Europe in the M&A world for practical SaaS founders. Thanks for being on the Practical Founders podcast.
Thanks, Greg. It was a great pleasure.
Thank you. Thanks for watching this week's interview on the Practical Founders podcast. Be sure to like this episode and subscribe to the Practical Founders YouTube channel to keep up with my weekly in-depth interviews with serious software founders who are building valuable software companies without big funding. You can check out my blog, all the podcast episodes and information about my Practical Founders CEO peer groups at practicalfounders.com, or message me on LinkedIn if you'd like to connect. See you next week.